And we are back. How is everyone doing out there? Hope you are doing well. My name is Andrew Kuhn. That's at Focus Compound on Twitter if you do want to give me a follow. Geoff Gannon, how's it going over there?
It's going well, Andrew. I'm at Geoff Gannon.
I was going to say, tell the people your Twitter.
That's my actual name, yeah.
That is your actual name. Tell the people your Twitter handle. Hope everyone's having a good day out there. Thank you very much for tuning in. This is the voice part of our business, the podcast part of our business. If you do want to get access to our website where we have a bunch of people writing about investing ideas and individuals and professional investors, go to focuscompound.com and be sure to sign up using the podcast promo code, which is podcast, and I'll take some money off of your monthly subscription price. So today we're going to be talking about float. And float is sort of this magical word that we talk, or that a lot of people like to reference in the investing business because of Warren Buffett always talks about it, quite frankly. I don't know if a lot of people actually know what float really is, or like examples of float. So I think it's a pretty good topic to talk about.
Sure.
So the way I think about float is obviously the people that do reference it, they always talk about in insurance, how we all pay premiums and the insurance company could take that money and can invest it because they don't have to necessarily pay those premiums out today. And then you could generate money on that free money, essentially. Another simple way of looking about it is think about if you ever rent a place or you live in an apartment or whatever, you have to pay whatever first or in last month rent or deposit, and that you could potentially get back when your lease is up. And that person that owns that property, they could essentially, in theory, take that capital and reinvest it elsewhere, earn a rate of return on that money practically for free. And obviously, float is what has made Warren Buffett pretty much one of the richest guys in the world. Was he number 2, number 3, but who's counting? So what do you think about float? And obviously, it's something that you probably look for in a lot of companies. There's a bunch of different types of float. But what is float to you? And what do you think, like, how do you look for it in businesses?
Well, float's very useful because people usually undervalue it. Investors usually undervalue it. So they focus a lot on earnings, which isn't as important as the cash flow of the business. So float is a timing difference. It means, so your average business tends to have a timing disadvantage, which is that it has to invest in stuff before it can make money on it. So it has to buy inventory before it can make profit selling inventory. So float is kind of the idea that what if I could sell inventory before I have to buy it, right? And in some cases, that's what companies actually are able to do. So if you have a negative working capital cycle where if you pay your suppliers after your customers pay you, then you have float. So like an online business selling to customers might be getting 30 days from their suppliers to pay, and yet their customers have to pay with credit cards the day they buy it, as it ships. So if they can ship their items within 30 days of being invoiced for it by the supplier, then they obviously are able to get paid for something that they don't actually haven't actually paid for yet. So they're getting paid for it from their customer before they've paid their supplier for it. So that's float.
Do you think a lot of people spend more time on the income statement than they should, and they should be more focused on the actual cash that's generated from the company?
Yes.
Can you explain the difference in that?
Well, the income statement doesn't matter.
Yeah, and the way I think about it is you think about like a tech company today, where's a lot of their, I guess, their expenditures. It probably goes on like the R&D line. So they could show a bigger negative profit than a company like Walmart back in the earlier days that was allowed to capitalize that expense on the cash flow statement. So their earnings weren't as obviously probably negative as a lot of companies. So that's why me personally, I always tend to go to the cash flow statement because it's cash. It shows what they're doing in the business.
Sure, and cash flow is what matters. So say you buy a ship and you pay $1 billion for it today, and then you use it for 30 years. Well, you depreciate over 30 years. So your income statement shows that you're paying for it for 30 years. But the truth is you paid for it up front. And you need to have a much higher return to justify paying up front for something that you're only going to make returns on over, or some of your returns will come from the back half of that 30 years. So the cash flow dynamics are very important. The timing is very important. So, I mean, we were talking before, if you see a company where free cash flow exceeds net income, it means it's either a positive working capital company that is shrinking or a negative working capital company that's growing. And you know that. So most people assume that net income, that free cash flow will tend to be lower than net income, which it will. But for some companies out there, free cash flow is always higher than net income as long as they keep growing. So like an ad agency follows that pattern. But so would publishers of different subscription things. Anything that gets subscriptions up front would tend to have that characteristic.
Sure. I mean, in deferred revenue, that's a form of float
sure,
as well.
So deferred revenue shows up on the balance sheet as if it's a liability.
Yeah.
However, in many cases, either just realistically what will happen, or actually, according to the rules of how they made the agreement, what they're going to have to deliver is the service. They're not going to have to return the cash at any point. So it's not a liability in the same way debt is. If you see a deferred revenue item of $100 million, they're just going to provide, whatever the title is. So say that you could pay for, focus compounding. It's possible to pay a year in advance.
Mm-hmm.
If you pay in advance, the way that looks on an income statement for focus compounding would be that the income statement on an accrual basis shows you as having basically equally over 12 months produce revenue and profit of the amount that you paid. But the cash flow is that it comes in at the beginning and then it doesn't come in for the next 11 months. And then if you renew, it comes in, again in the 13th month.
Yeah.
So it's completely different. And it's the cash flow that matters. It's not the income statement.
Mm-hmm. No, I think it's a simple way of thinking about it. What companies have you seen or come across where they were generating enormous float to the point where it was important to the investment decision?
I'd say, ad agencies is important to the investment business, to the investment decision.
How does it work then with them?
So the average company would maybe convert at very best 95% of their net income into free cash flow, whereas a ad agency, it's not unusual for them to convert 105%.
Wow.
So they can buy back stock and pay dividends that are equal to more than they earn without piling on debt. And like Omnicom for the last 15 years or so says that it has done about 105, 106%, something like that. So it's meaningful that way. In terms of the math, one way to think about it is, for all stocks, is that your return can kind of be estimated. One way of thinking about it, to try to compare value stocks and growth stocks, is that your return is free cash flow yield plus growth in percentage terms, both of them. So if you think a company's going to grow 6% a year and you want a 10% return, you need it to have a free cash flow yield of 4%.
Yeah.
If it has a free cash flow yield of 8% and you want 10% return, you need 2% growth. Now, over time, the compounding gets you away from just thinking in that simple a term, but that's not a bad way to think about it when you buy a stock this year to see what your return is this year, is that you need growth and free cash flow to add up to whatever your sort of hurdle rate is, your target.
And that's sort of how we always think about it as well.
So a company that has float can grow without having to retain earnings. So a typical company historically in the U.S., big company, grows at 5 or 6% a year, but only pays out 2 to 3% a year in earnings. And that gets you to, a high single digit to low double digit return for the stock. And that's why stocks return that kind of number. But for a company with float, if it trades at a free cash flow yield of, say, 6%, then it has that free cash flow, plus it has growth, but it doesn't need to retain anything in growth, right? Mm-hmm. So if a stock trades at 15 times earnings but has to retain everything to grow, then it could still be a good deal because maybe it's growing 15% a year. If it's growing 15% a year and you want a 10% return, that's great. If you're growing that fast, you don't need to be producing free cash flow right now. But it's the combination of free cash flow and growth that matters. And companies with float, basically, I've said before, they get to have their cake and eat it too. They get to produce the free cash flow and grow without paying for that growth, right? And actually, the more they grow, the more free cash flow they would produce. The more they shrink, the more it would reverse, and their free cash flow would drop faster than other numbers you're looking at.
A lot of people in the Valley community that are focused on finding compounders, they always talk about like return on invested capital, ROIC, return on incremental invested capital.
Oh, yeah.
And how do you sort of think about that and how that relates to flow?
You can't calculate that number.
Yeah, a lot of people tried, though.
It's not possible.
Why do you say that?
It's not reliable. It's a silly number to try to calculate. I mean, it's theoretically the correct number to try to calculate, and that's fine.
It's ROIC.
Yeah, but what you're trying to do is get the marginal number on a smallest piece of length of time. So you're doing 1 year what they invested this year versus what that return gets them. It's not a stable enough number to be able to do the calculation. So it'll give you weird results.
So for like you just kind of factor in, this is a very high return on invested capital business and kind of go
No,
from there.
I look at what they're going to spend it on.
Uh-huh.
I think we've done that before, where
Yeah,
I
we
say,
have.
okay,
Yeah.
so they'll probably spend this much on dividends. Okay, then you pay a tax on the dividends, so that's less. They spend this much buying back stock. Well, if the stock's attractive and we think it's going to return more than 10% a year, their buybacks will also return more than 10% a year in that sense. And so you do the calculation that way. And then like whatever they're investing in, like acquiring things, I do that calculation too. Over time it matters what the return on, how do I put this? The return on equity at a company doesn't matter. What matters is the return while you own the stock. So the fact they made a terrible investment in the past that's earning 2% on their purchase price does not matter if you get into it today, unless they're going to do that same thing again. I was talking to someone recently about a company that's, I don't remember, maybe $13 billion project or something. So it's a big project, and they expect certain returns on it. One of the issues was, okay, is this a good project or not? No, I think the returns are going to be that high. They're going to be in the high single digits at best. Okay. Then the question is, will they ever do this again? Because it doesn't matter that they made this decision in the past if they're sinking that cost into it and that's it, right? But it matters in the future what they're going to do.
Sure.
Right? And so that's the only number that matters that way. So yeah, return on incremental invested capital would theoretically be the right number. But it's not meaningful because it's not a number you can measure correctly, in my view. Other people may disagree. Have you looked at the number?
Well, yeah, but
do you find it to be stable?
No, not at all. I mean, I know a lot of people do it. Sort of the people in the compounding community. A lot of people always talk about it. Return on incremental invested capital.
Yeah, I think it's a very important number. I just don't think we can observe it.
Yeah, sure. But you do sort of observe it, but not the way that they do it, I would say.
Over long periods of time and stuff,
Absolutely.
you can observe it.
Yeah.
Yeah. No. When I say you can't observe it, I don't mean that you can't get guesses about what it is over long periods of time. I'm saying if, like, they're going to show what it is quarterly and annually.
Yeah. That's very hard to do.
Yeah, and then you add in the fact that you want cash instead of accrual. Those are, I've said before, you need to take 3-year average of free cash flow, not 1 year, just because there's all sorts of items that you're not going to notice in the free cash flow statements that are in the cash flow statement that's changing, just in terms of like inventories being drawn down or up or whatever. That's just an issue of timing.
What are other forms of float that people could look out for? I know we talked about like deferred revenue.
It'll show up as deferred
model.
revenue generally. Yeah. All database companies have it usually. Any subscription model has it. Premiums for an insurance company are basically a subscription model. Any subscription, you have it. So generally, it's a subscription company. We don't think of insurance as being something you subscribe to, but it is. So, with ad agencies, I told you it's the difference between the timing of the payments. It can happen with companies like that. Dell, I think, had negative working capital. Amazon in some of its businesses has negative working capital, and some it doesn't. We talked about that a lot with, like, when we wrote about Granger and stuff. Amazon for selling for consumers would be able to generate float, but selling business to business would not be able to generate float. So because you have to extend credit to businesses, they won't put up with not getting credit.
So do you think like when you learn about float, it just really comes from obviously learning about their business model and then?
Well, it's looking at certain
and then like things on like the cash flow statement and obviously if you see like deferred revenue on the balance sheet.
What I tell everyone to do, my big suggestion is take whatever company you're looking at, take like 15 years of their history, add it all up, all the free cash flow, add up all the net income. Divide one into the other to get the ratio of free cash flow to net income. In almost all cases, you're going to see the free cash flow is lower than net income. But and you'll see how bad it can be in some cases, which can be very bad for companies that are very asset heavy. But you just look for the companies that generate more free cash flow than net income, and those would be the ones that have float over time. They can do it, like I said, if they're shrinking, if a company's liquidating, if it's getting smaller, if it's closing stores and selling inventory and stuff, then yeah, it could generate free cash flow in excess of net income for a while it's shrinking. But the average business has to invest in growth before it grows. Any company that gets paid to grow, cash comes in at the first step of its growth, is a company with a float.
That's probably a good company. Or it's a good situation.
Yeah, we have a write-up on the website that someone else did, not me, about a senior living community in New Zealand, I believe. And they get float because they get deposits from people. And so basically they use the deposits that they get from their residents to build the next building.
So it's almost like it's financing their business.
It's like a perpetual motion that way until they stop building more things,
No, that's definitely interesting. Or until it doesn't work out.
Yeah. So a business with float is one that's financed by customers, basically.
Yeah, I think that's a good way.
Because the entire bank portfolio of assets is funded by float. It's depositors. Yeah.
Sure. I think that's a good way of describing it. Do you have any other thoughts on the topic?
Nope, that's
Float. Well, great. Well, we want to thank everybody for tuning in to listen to us here today. If you do want to get access to Geoff's weekly memo that he does send out, go to focuscompounding.com. And if you do become a member, there is a database of all of Geoff's weekly memos that we've sent out that you can reference. Also, if you do want to follow us on Twitter, Geoff tweets all day long.
All day.
I'm
every
just
day.
kidding. Go to that. You can find him at Geoff Gannon. That is his name, Geoff Gannon, Gannon. And I am at Focused Compound. Other than that, thank you very much for tuning in. We will see you in the next podcast. Take care.